returns with our structure, you're getting 300 to 500 basis points.
Welcome everyone to The Landscape. This is George Smith Partners podcast. We're very excited to have you here today. I'm here with my trusty co-host, Mr. David Pascale.
Hello, everyone. Glad to be here.
As always, go to www.gspartners.com and sign up for FinFacts, which is our weekly newsletter. David puts out a piece pretty much every week on the economy, macro, and rates, and it's extremely well read. So, and very informative. I will give you a plug here, Mr. Pascale.
And it has information on all the loans we're closing and hot money that we see in the marketplace and other think pieces and takeaways from conferences and the like.
That's right. And with us today, we have a very special guest, Mr. Max Bartmann from MSP. And without further ado, I'll flip the floor over to Max, and maybe you can give us a bit of, a bit of introduction.
Thanks, Evan. Thanks, David. It's good to be here. I'm Max Bartmann. I work at Montgomery Street Partners. I'm a vice president there. And then I'm also the head of Northeast Investments at Ground Lease REIT, which is an externally managed REIT of Montgomery Street Partners.
Great. Good.
All right.
So let's get started with ground leases, and maybe give us an overview of a ground lease and the advantage that they offer to landowners and developers and the like.
Yeah, happy to do it. I mean, the ground lease structure has been in the market for thousands of years, primarily starting in the UK, and it has been an estate planning tool for families in the United States and for universities and large institutions that want to control the land and ultimately the residual value of that real estate on a long duration basis. Relatively recently, about a decade ago, institutional investors wanted to use this structure to provide a new source, a unique kind of debt-like source to the real estate capital markets. So Montgomery Street has raised this dedicated bucket of capital really to originate ground leases across the US, kind of as a form of financing to the market. And the structure is quite simple. It's typically a 99-year lease where we are the landlord under the structure. Our tenant is usually the owner, operator, developer under the structure. And we provide a very cheap source of capital that is the senior most part of the debt capital stack. And in concert with leasehold senior financing, we try to offer a unique solution to our customers who are really borrowers that are working with both of you to recap their opportunities, acquire new assets. And our kind of bread and butter is multifamily development. So that, I think, kind of encapsulates what we do on a day-to-day basis.
And summing it up for our sponsors out there and borrowers is, what Max Bartmann's company will do is, if you are buying an asset or own an asset, fee simple, a classic ownership, they will come in and own the fee and provide a 99-year ground lease to the owner of the improvements, and that will and they will pay for that, and that provides a source of liquidity or kind of like an equity for owners of real estate. Is that about right?
Yeah, that's exactly right. I think just to explain by example, let's say you have $100 million development, and you might get comfortable based on our sizing criteria of funding $40 million, right? Land might be worth 10, but hard, soft carry cost is another 90. So ground lease is a little bit of a misnomer, right? It has our funding and sizing has actually nothing to do with land value. It has everything to do with the future cash flow and stabilized net operating income from the property. So in a development deal, Evan, let's say that you own this site unencumbered, for 10 million bucks, we'll buy it from you. At the same time, we'll simultaneously lease it back to you under a ground lease structure and close a construction loan. So we have funded 10. Let's say that construction loan's another $40 million. So it's 40 from us, 40 from a construction lender, and then $20 million of equity. We'll fund 10. The $20 million of equity goes into the project next. Then we'll fund $30 million more. So we're fully funded. And then typically what happens is the leasehold construction lender funds last. So that is kind of the typical sequencing of funding and how we kind of size our individual deals.
Yeah, that's great. And just really quickly before I jump into it, talk about how, not with excruciating detail, but generally you guys are you're pricing the deal with a spread over a long-term rate. So like the 30-year treasury.
Yeah, that's exactly right. I mean, we're writing and originating these 99-year effectively fixed income, inflation protected century bonds. And so there's not a lot of good guideposts or kind of fixed income products to compare this to. So the most common one that we like to use that a lot of real estate investors are familiar with is the 30-year US Treasury. So for example, today, let's say I think the 30-year Treasury is at 415. And so an 85 basis point spread to the 30-year Treasury on $1 million of ground rent would be a going in yield of 5% or a 5 cap. And if we have a property that throws off $4 million of net income, we'll size to call it a 4.0 cover, which imputes to $1 million of ground rent. Divide that $1 million of ground rent divided by our going in yield, remember 5%, that's $20 million of proceeds.
Right. No, I totally get it. So let's talk about, I think, what I've seen to be like one of the challenges, I think, with the ground lease, and that is sort of the subordinate financing. This would be a typical senior loan, which is now subordinate to the ground lease. You know, just to give a little bit of spin, maybe before you answer it, obviously the last couple of years in our world and your world have been slow on a transactional volume basis, just because of the the rapid increase in rates that we had starting back in the middle of 2022, and the impact that had on the broader market, and then sort of the lack of availability of construction financing. But now it seems like the market's sort of re-stabilizing a bit. But you know, notwithstanding all the overall broad market challenges that we can get bogged down in, let's talk about, you know, the actual mechanics of that senior loan, and if you guys are seeing some, you know, interest from senior lenders, and just kind of where you see the market today.
Yeah, that's a great point. And so the linchpin to all of our deals is finding that lender that will partner with us to effectuate that capital structure. Really, in our world, we call it a ground lease bifurcation. So usually there's not, you know, a ton of equity coming in. You know, 60-70% of the stack is not typically equity. So you need a lender that you party with, so that you can partner with. And so it's really a tri-party agreement. And so that's what makes these deals typically a little bit complicated, right? Because you need to have three groups that understand a pretty nascent structure and have to get comfortable with what we call a leasehold financing agreement, which is in essence a recognition agreement between two capital providers, quote unquote lenders. So the market really from the top down has been challenging because, you know, when rates gapped out, you had very little transaction volume. I think, you know, I saw today sales year over year this quarter have dipped 60%, and then before that, sales from between 2023 and 2022 have dipped, you know, even more than that. So there's just very little trades in the market, and I think that's just been precipitated by a lack of, you know, common equity willing to kind of plug that gap. So everyone is trying to find like gap financing, and really everyone's come up short, whether it's the sizing requirements for agency takeout, whether it's needing an additional $5 million on a $70 million development. All of that has kind of stopped in the system. And I think we've kind of turned a corner with this first 50 bips from the Fed. We've started to see, more activity. I'm starting to get more inbounds from people that want to, relationships that want to look at different types of structures to progress their deals, whether that's, a deal they shelved that is a development deal that they decided, we're going to wait until rates improve, and then we're going to try and build it in 2024, 2025. So there's definitely a lot more activity. I think across the broader real estate universe, you're seeing that. And going back to leasehold financing, we're starting to see more groups that I think have been frustrated in the lack of transaction volume that are saying maybe this is a creative way to solve for my total return, and also, provide capital and close on opportunities with sponsors that are really willing to take this type of structure seriously. So, yeah, I would say, there's a thinner bench of leasehold lenders specific to transitional deals. And those transitional deals, I mean, development, office to residential conversions, stalled construction sites that need capital to finish. Those are the types of deals that GLR does. And we do that because we find that we can be more competitive. We're willing to lean into that risk. And so to find lenders that are comfortable with that deal profile, and on top of that, they have to think about structure is tough. But I think this kind of mounting frustration and debt capital on the sidelines has kind of started to kind of flow through the system, and people are willing to lean in with us. I can speak to a couple of examples of that, but one that comes to mind is we're working on a $350 million development. We have it under LOI. It's a 4-building multifamily development in the outer boroughs of New York. And we're a $100 million ground lease provider, and there's a $200 million loan behind us, right? This is a group that we've closed with. We've actually refinanced so that we've round tripped a deal with them, but they haven't done too many large loans in the past 24 months. And this is a unique way for them to kind of make the capital structure work and also kind of fund into, an exciting opportunity.
So quick question. I mean, on that deal, you don't have to give me specifics. I know it's private, but talk a little bit about the spread or the difference in rate between where you guys are buying, where you guys are at with your ground lease and where the senior is. Because obviously the reason to do this is that hopefully the overall weighted average cost of that financing is a little bit lower, and because of that, the senior lender, which is a subordinate lender to you, is reaching up a little bit deeper into the stack. So,
right.
Yeah,
it's a great question. So let's say we're pricing in the mid 5% all in, right? So some mid 125 basis points spread to the 30-year Treasury today implies, on a $100 million ground lease, $5.5 million in year one of ground. And so the lender, I think, because my cost of capital is cheaper, the cash flow net of the ground rent, they're able to size and solve to their debt yield requirements, call it 9.5%, and get to more. So on a fee simple deal, let's say they're able to get to 250. With our structure, we're able to eke out another $50 million of proceeds with the ground lease. So that's like probably that $50 million, as far as I'm concerned, is additional equity, right? That is found money that you wouldn't be able to replicate unless you have a very, very expensive execution. And to your question, Evan, the cost of that capital is, between 550 and 650 basis points spread to the 1 month SOFR, right? So that cost of capital is low double digits today. but there's a couple of things to take into consideration besides just the incremental proceeds. You know, the project, we and the equity will have funded first, so the developer isn't drawing on that expensive money for a very long period of time. You know, they might have topped out on all of the buildings where they've drawn on any of the debt capital. And so what we've seen is when you look at the equity returns with our structure, you know, you're getting 300 to 500 basis points of incremental IRR, apples to apples to the same deal on a fee simple basis. So it's incredibly compelling for developers to take into consideration a ground lease bifurcation. And then I think thinking through the stack ground lease plus that senior leasehold construction loan, you know, the blended cost, I would say, to get to 85% of total cost is around 8.5%. So it's very, very cheap just on a kind of apples to apples basis.
Yeah, compared to high leverage mezzanine or super senior loans, that's great pricing.
Right. So you're saying we're saving like 200 basis points, which yields you another $50 million, or yeah. So that's kind of sort of the net effect of what the outcome of the capital structure is. So interesting. No, that's great. I'm glad to hear that, you know, business is kind of like expanding. You're seeing more interest in transactions to occur. We're seeing the same thing in our business. You know, it's kind of been a real explosion, I guess, recently of, I guess, what I would call transactable deals, real deals with
people
folks.
Are hungry to transact again.
Exactly. So let's switch gears here. I think, you know, with respect to like doing deals in different markets, what sort of considerations should borrower, you know, developers be thinking about, you know, with respect to different cities, municipalities, states? Like, what sort of variation have you seen that might impact the ability to do a ground lease that works for your structure?
Where are you hungry to provide best terms? Is it the gateway cities, suburbs? Just give us a feel.
Yeah, I think there is some premium to our investments where you have infill viability, call it New York, LA, Chicago, kind of the cities with the most density. But I would also say that, you know, the mandate for GLR's program is much broader than that, right? And I think we're willing to preserve that same kind of unique pricing because these are kind of few and far between and difficult to originate. And Evan, I think your words were, you know, closable or transactionable deals, right? We're starting to see the same thing. And so, but we've done deals in the Pacific Northwest and affluent suburbs. We've done spec retail developments. We've looked at, you know, even office deals today. We have, you know, office to or hotel to residential conversions. We've kind of, it runs the gamut, but from a geographical standpoint, I think we're willing to kind of go wherever the developer is, provided that it's within our kind of infill viability buy box, which is pretty loose. But I think that for the ground lease investors, we definitely will command a premium by doing deals where there's, you know, a major path in growth and infill viability.
Yeah. So, you know, one thing I think worth pointing out, because it's not necessarily to your benefit, but maybe just talk a little bit about valuation and cap rate and sort of the impediment that a ground lease may put, you know.
Well, that it's just the borrower's chief concern. Maybe just address, you know, cap rates and valuation, ground lease versus fee simple. That we hear that a lot.
Yeah, I mean, it's certainly, and this goes back to the geographic question, right? In New York, maybe every other building is on a ground lease, and so the investment community here and is very, very familiar with buying real estate subject to a ground lease. In LA,
Right.
not so. In Miami, not so much. But that's changing, right? And that's going to continue to change as there's more capital and more ground lease bifurcations that happen. Because once one happens, it's it's very rare that they kind of merge the leasehold interest back with the lease fee interest. That doesn't happen so much. So over time, as we continue to deploy capital and raise more capital for the strategy, there's going to be more deals that happen in LA, for example, right? And so going to your question, Evan, about, hey, what happened if I do a ground lease bifurcation? There's this, I talk to the market and there's this value destruction. How much if my asset trades at a 5 cap, does it trade at a 5.5 cap or a 6 cap today? And so I think there's a couple ways to kind of tackle that. I think a lot of the advice that you're hearing about, value destruction is because there are very rarely do these trade, but very rarely do you hear about ground leases in general unless something is wrong, right? There's many ground leases where there's negative headlines associated with the Chrysler building, the Mobile building, all here in New York, or there are these kind of fair market value resets that are built in legacy deals that have been inked in the 1970s that have really kind of upset the apple cart and upset the value distribution in the leasehold and in the lease fee interest. So I think that is a little bit of noise, but it's not something that I think really impacts value if you're creating these kind of modern balanced ground leases. We tell our sponsors or counterparties, tenants, to underwrite 25 basis points of cap rate expansion. We've done a lot of work on this. We've looked at the residential sector in the secondary and tertiary markets, and not every ground lease is the same as a percentage of NOI or term or CPI, et cetera. But what we have also noticed is that, that if you look at trades on a cap rate basis for fee simple deals, and you compare that to leasehold deals, in similar markets, there's really only a 15 basis point spread in cap rate expansion. Then the third point I think would be really to, the folks listening in on the podcast and some of your clients is that, on these development deals where we're able to manufacture, a structure and an execution that is a better blended cost of capital, more in proceeds, and we're funding into the deal first and you're drawing on that expensive money later. So that three-pronged kind of piece to the development ground lease bifurcations, regardless of how much you sensitize the exit cap rate, right? If they think it's a 5.5 cap on the exit, and I say, great, look at it on a 6 cap under a 5-year hold period or 6.5 cap, I'm still very confident that the total return to the equity will be higher under our structure. So it kind of shoos away that entire argument on development deals, which is really another reason why we love it, is because we have a higher hit rate there because the value proposition is kind of, hyperbolized, if you will.
Got it. All right. Question, I want to switch back to a question we were talking about earlier, but I'm just kind of curious because, there's been so much chatter about it. Are you guys looking at data centers and some of these, go ahead, yeah. Or are they a little bit too off the beaten path, so to speak, because they're not necessarily gateway markets and maybe outside of town and so forth. But
or these giant industrial parks that are springing up around the new chip facilities. There's just a huge investment in this AI boom in real estate.
Yeah, I mean, I think it's a great question. We absolutely see a lot of different things come across our desk. I mean, we have we're evaluating a couple of data center opportunities now that are large scale, but I think we have to be very, very mindful about basis, like anything else, right? I think there's a ton of value and income that's being generated from kind of like the operating company or the opco. And, you know, the real estate, if that goes dark for whatever reason, and there's no credit behind that underlying tenant in that data center, you know, although it's strategically really well located and tons of dollars have gone into it, you know, we don't want to be kind of stuck with the bag. So, you know, personally, I actually like multi-tenanted real estate. For example, shallow bay, light industrial, a lot more because you can backfill smaller tenants and you have a diversified group of tenants versus a single user. So those kind of sale leaseback, advanced manufacturing deals that are getting done or data center deals that are getting done, you know, it's tough for us to generate really and be competitive in terms of proceeds because versus, and there's a lot of liquidity in that market today too, right? So it's very difficult for us to kind of think through the price per pound, if you will, and get comfortable. But there are sometimes opportunities that we're willing to lean in on.
You mentioned some of the historic, like legendary ground lease issues with the 1970s written, that you could tell they were written on a typewriter, poorly worded ground leases. Today, it's a very sophisticated market where, you know, people go to S&P. S&P has issued very strict guidelines on ground leases. Everyone, the agencies and CMBS has agreed upon them. So people shouldn't, you know, believe the hype on some of the publicity on these old ground leases, that it's changed a lot. I was just going to say that.
No, that's a good point.
Yeah, we might edit some of it in.
Perfect. No, I absolutely
do you see, here's my question. When you're starting a ground lease, someone says, I want to start, do you start with the S&P requirements? You have your own S&P compliant ground lease that all the capital markets recognize? Like maybe talk about that a little bit.
I mean, the market has changed a good amount, but has been kind of standardized. Our peers have done a really great job. I mean, the best example of that is a publicly traded REIT called Safehold, who's, you know, our direct competitor and has been in the business for, you know, 5 or 6 years longer than we have. But you know, typically they're 99 years. They're upward only, meaning there's fixed increases of 2% per annum. Our ground leases we like that of the feature of inflation protection. So every 5 or 10 years, subject to a cap, there is a CPI look back, which, you know, kind of right sizes the ground rent. And then, you know, beyond that, we are really focused on the underlying cash flow and how the property kind of performs. We have this golden rule that we talk about internally called do no harm to the leasehold. You know, we're here to build a portfolio of these cash flowing, you know, really inflation protected AAA fixed income products, right? And so that means that we want to make sure that we can really underwrite the cash flow, get comfortable with it, and make sure that our ground rent payment isn't cannibalizing the NOI so that there's liquidity on that side. So I'll give you some kind of great background. You know, we have a couple of deals that have either gotten TCO or are in lease up or they're stabilized. And so those don't have construction loans anymore. They have bridge to agency and debt fund capital that has taken out those existing loans. And so that is a great testament that we're doing our job in making sure that the ground rent isn't too high and that the cash flow from the property can not only support ground rent payments, but take out that loan, that existing construction loan and pay for, you know, debt service and ultimately cash flow to the borrower. So that I think is the most important thing, is that you're sizing the ground rent to a level that keeps value balance between the leasehold and the leased fee.
That's great.
Good.
Great. Well, Max, once again, thank you so much for joining us today.
Thank you very much.
And David, one more plug for you, or actually, Max, you plug yourself first. Where do people find out more about MSP? You know, where do we go to find you?
Yeah, I mean, I'm happy to take calls from some of your subscribers if you want to post my information, my email, but MontgomeryStreetPartners.com, there's a lot of information about the ground lease REIT, but yeah, I'm happy to have conversations with stakeholders in the market and always open to networking. So
Great.
And of course, for us, gspartners.com, sign up for FinFacts.
That's it.
And thank you, Max.